Welcome back. In the previous chapter, we were after finding appropriate expected rates of returns for stocks. We looked at how managers and investors can assess the expected rate of return of projects and firms based on decomposing them into a safe component and a risky component, and then benchmarking these components to the risk-free rate and the equity premium, or comparables. We're still after the same question, but now we go a step further. We did not distinguish between different kinds of stocks. Every stock offered the same expected return, and we ignored our beautiful measure of co-wiggling from Chapter 8. Shouldn't stocks that co-wiggle more have to offer higher rates of returns than stocks that co-wiggle less? In this chapter, we're now taking this extra step. In addition to the risk-free rate and the equity premium, we are adding a beta premium. This will offer up the most prominent theory of finance, the capital asset pricing model, or short, the CAPM. Again, we start with our perfect capital markets assumption. No opinion differences, no taxes, no transaction costs, no big buyers or big sellers, and we have infinitely many people. So it's a very, very competitive market. And we're still going to have risk and risk aversion. But unlike the previous chapter, we're going to rely very, very heavily this time on the assumptions of a perfect capital markets here than ever before. We're going to answer the same questions as before. What makes investors give us money? We want them to give us their money so that we invest it in projects on their behalf. What is their opportunity cost of capital? That is, where else could they invest their money in, which is what we should take as the benchmark for our own choice of projects. What is the best cost of capital, the discount rate that we're going to use in the net present value formula? Unlike benchmarking, which only leaned very mildly on this, we're now going to use a very, very strong theory. And that theory is going to tell us, it's going to inform us what the best comparable is. If our theory then is correct, we have great guidance on what it means for projects to be similar. If we are wrong, then we're going to use a nonsense number. So this theory needs more and stronger assumptions. I'm going to try and convince you that this theory has quite reasonable assumptions, and these assumptions may be sort of nice if you have a lot of academic overconfidence and no measurement error and no model error, no this error, no that error. It isn't like this, but let's first see what the theory holds. So here is my assumptions. Investors dislike risk. They are smart. They care about default. They care about term, and they care about equity risk. And we're going to have some stupid investors in the market, but they are too small to matter. So the prices are more determined by large investors that are going to make sure that prices are not too far out of whack. Or if they were far out of whack, they would buy or sell in order to bring them back into whack. Now, next one. Investors care only about portfolio risk and portfolio reward. And we can measure risk by the overall portfolio standard deviation. It's another big assumption. And these investors are, for the most part, holding something very similar to the market portfolio, which makes sense because the market portfolio has a lot of different assets in it. So it's highly diversified. This is something along the lines of what investors should hold. And now I'm going to ask if my very smart investors who dislike risk, like expected rates of return, what kind of projects is the kind of project that they would like me to take on their behalf, me as the corporate managers. We're also going to assume that they don't care about other risks that they want to hedge, things like political uncertainty or inflation or oil risk, or something else. I'm going to just ignore this. I'm just going to say all that they care about is portfolio risk and reward. And I'm going to do my best to offer them a project that, if they stick just a little bit of that into their portfolio, is what they want. What did we assume away? we assumed away anything that's not in the perfect capital market. We also assumed away things like this. There is no unique labor market. So what does this mean? That means that I, for example, work in academia. You may work in waste management. Now, if you work in waste management and I work in academia, what I would like is a security that if I get fired from academia is going to give me a lot more return, because that's when I really need it. That's when I really urgently need money, but I don't care very much about what happens with waste management. You, on the other hand, would then want to buy something that goes up a lot when waste management goes down. By waste management going down, I don't mean flush down the toilet. I mean the stock price goes down and they lay off a lot of people. Of course, waste management turns out to be almost as safe an industry as academia. So these are good ones. But take a more extreme example. Take working for an internet company up there in San Francisco. If you get laid off because the entire internet industry goes down and they don't hire people anymore and your salary doesn't go up the same way that it used to, you want something that goes up when the internet companies in San Francisco go down. All of that has been assumed away. All investors here are perfectly alike. They only care about their stock market portfolio, and that's it. Similarly, houses. For most people, houses are their main asset. So if I own a house in Brentwood, I want other stock market assets that when my house in Brentwood goes down in value, those assets go up in value. That would be a hedge. It would make my life safer. Your house may be somewhere completely different. It may be in Las Vegas. It may be in New York. Under those circumstances, you want something that correlates differently in New York. So you would want to hold a different portfolio from me. Again, all assumed away. Another thing that we have assumed away is state-dependent preferences. What that means, it's a fancy word for saying, in the previous examples that we did in 2 chapters ago, I had these playing card things and we computed the expected rates of return for the different scenarios and what the variance were. And you cared about all these scenarios the same way. So we could equally weight them. That is not necessarily true. There may be some particular state-dependent preferences where I want to get more money in the club's case than in the heart's case. And I have assumed away that I have uncertainty about the inputs that I need. Things like the expected rate of return on the market, the standard deviation of the return of the market, the variance of the return on the market, and whatever else. So I assume that I truly know this. This is a model. No model is perfect. That's the whole point. So we're not trying to describe reality perfectly. We're trying to describe reality with a model that is much, much simpler and which we can understand. These are all reasonable assumptions, but they are all very strong, and our model will lean very heavily on them. Now, should projects that add more risk to your overall portfolio need to provide you with more reward?
Please pause this video now, answer the question on a piece of paper, and then continue.
Of course. Otherwise, why would you want that kind of project? What is a good measure of the risk contribution for our projects if you are holding the market portfolio?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, that we've already done, like 2 chapters ago, something like the market beta, which is sort of a renormed version of the correlation and covariance of our project's rates of return with a market rate of return. Should projects that have high variance, but whose risk can be diversified away in a market portfolio because the risk is uncorrelated with a market portfolio, have to provide you with more reward to hold it?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, there are so many investors competing for the financing projects. They don't care about the variance. You're just a tiny, tiny, tiny fraction of their portfolio. They don't care about something that if the market goes up or down relative to their other portfolio, it goes up or down a little. It's just far too little. They care about market beta. They don't care about variance. We are going to take all of this into account in a model called the Capital Asset Pricing Model, for short CAPM. This formula says that the expected rate of return of every project, which I'm going to denote by I, that's the name of the project, is linearly related to this project's market beta. So the formula looks like ERI equals some constant, 1, plus another constant, 2, times the beta of this particular project with respect to the market. These are two constants. They are the same for every project. They're not specific to a project. So let's guess them. What should these two things be? First, what asset has a market beta of 0?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we've already done this. The risk-free rate. It doesn't co-wiggle with anything. Therefore, it has a market beta of 0. We're going to call this one R subscript F. What asset has a market beta of 1?
Please pause this video now, answer the question on a piece of paper, and then continue.
This got to be the market rate of return. We've already done that one too. We're going to call this ERM. So now I have two unknowns, constant 1, constant 2, and I want to fit two numbers here. I want to fit for beta of 0 an expected rate of return of RF, and for beta of 1 an expected rate of return of ERM. What are 1 and 2?
Please pause this video now, answer the question on a piece of paper, and then continue.
Number 1 is the risk-free rate. Number 2 is ERM minus RF. Plug in beta equals 0, and out of this formula comes RF. Plug in beta 1, out of this formula comes ERM. You must memorize this formula. This is perhaps the most famous formula in all of finance. It says the expected rate of return on every asset in the economy should be the risk-free rate plus the equity premium times the beta of that particular project. You must be able to reproduce it without thinking. So this must come around. Dream of it. Dream nightly of this formula, please. And you must know how to use it. But please, don't believe in it. Don't believe it's true. And I'll explain to you later why I want you not to believe it without doubt. ERM minus RF is the equity premium. Any project that adds more beta risk to our market portfolio because it has a higher market beta has to offer a higher reward, a higher expected rate of return. The model tells us the measure of similarity that matters for pricing, that matters for the expected rate of return. That's the beta of your project. This is what identifies the appropriate comparables. The way to think of the CAPM is also as a line. It relates any investment beta I to the appropriate expected rate of return on this particular project, and therefore it's also called the SML, the securities market lines. Now, in what other context might agents care about the 3 CAPM inputs?
Please pause this video now, answer the question on a piece of paper, and then continue.
These are the 3 most important numbers in finance. So any consumption allocation, whether you should invest or consume, is related to the risk-free rate. any decision on whether to go risky or safe is related to the equity premium. And any hedging, that is anything that tells you how exposed you should be to the market, or how exposed an individual project is in the market, is all in this formula as well. So it's got the two most important numbers in finance, plus the most important concept in finance, which is the risk hedging, and that is the capital asset pricing model. If the CAPM works, your proper project comparable is market beta. It's not industry, it's not size, it's not leverage, it's not peers, it's not condominiums, it's not book value of the firm, it's not momentum, sexiness, growth, reliability, conservativeness, whatever Kramer thinks it is. None of these things matter in any way. The only thing that really matters is the market beta. Your particular project should offer the same expected rate of return as all other stocks with similar market beta. And that's the only thing that should matter in matching peers for pricing, nothing else. Now, of course, the CAPM still only gives you relative valuations relative to your estimate of the equity premium. That cannot be helped. I wish I could give you the equity premium. The model presumes you know it. In real life, you don't. What capital asset pricing model inputs are the same for every project?
Please pause this video now, answer the question on a piece of paper, and then continue.
RF and ERM. What capital asset pricing model inputs are specific to your project?
Please pause this video now, answer the question on a piece of paper, and then continue.
Project-specific only one, the market beta of your project. What signs do the two constants CAPM terms, that is the intercept and the slope, have?
Please pause this video now, answer the question on a piece of paper, and then continue.
Both should be positive. The risk-free rate is typically in nominal terms here, so it should be positive. And presumably you get a higher average rate of return going into risky security over risk-free securities, so it should also be positive. So let's presume for a moment that the risk-free rate is 3% and the ERM is 8%. Please do me a favor, fill out this table where for different betas, you give me the appropriate expected rate of return that you expect given this risk-free rate and given this expected rate of return on the market. So instead of giving you a table, I've graphed this for you. This is the security markets line. So if you look at that, you see on the x-axis is the beta, on the y-axis is the expected rate of return, and it looks just like a straight line. In this particular example, I have the risk-free rate as 3%. That happens when beta is 0. And the 5% is the equity premium here, so that when the beta is 1, I have an expected rate of return of 8%. If the risk-free rate is positive, would you ever buy a stock with a negative expected rate of return?
Please pause this video now, answer the question on a piece of paper, and then continue.
Absolutely. If you look at the formula, if the beta is really, really negative, it comes out with a negative expected rate of return. And that actually makes sense because that would be a security that whenever the market moves down a little, moves up so much that it's like purchasing insurance against stock market declines. And it's very common that we purchase insurance, that we do so, even though the expected rate of return on insurance is negative. In fact, you don't expect to make money on your car insurance either. Here you get insurance for your overall portfolio, which is far more than just the car that you own for most people. Why does the CAPM consider a zero beta but risky volatile project just as good as a risk-free rate?
Please pause this video now, answer the question on a piece of paper, and then continue.
The answer is because it is such a tiny, tiny contribution to the portfolio of the investors. Your project is tiny, usually even within your company. Then it's being held by many, many millions of investors. For them, it's only a tiny epsilon, which just wiggles a little bit. It doesn't really matter very much. So you don't need to offer a higher average rate of return for a project that has a zero beta. Okay, what about this problem? Let's say we have an equity premium of 4%, a risk-free rate of 3%, a corporate zero bond promises $1,000 in 1 year, and the market beta is 0.5. Can you work out for me what is the expected bond price today?
Please pause this video now, answer the question on a piece of paper, and then continue.
Time out. Time out. Watch this. Do not commit this very, very common mistake. The price of the bond has to reflect the promised cash flow, and we don't know what that is. So the CAPM gives you the expected rate of return. It does not give you the promised rate of return. If you make this mistake, please do me a favor, say you graduated from Harvard Business School and are very good at golf, not at finance. Never, ever use the capital asset pricing model to infer a promised price. The promised price contains the default premium, and the CAPM does not provide this. The CAPM gives you the extra expected return above the default premium. You have to add the default premium to it to get to the quoted rate of return, to the quoted price. So, CAPM, expected, not promised rate of return. The expected rate of return on the market has also already taken out the default risk. It's not the promised rate of return on the market, because for stocks, we really don't do it as much as for bonds. Usually when we quote historical numbers, we already have an expected rate, an average rate, not the promised rate. For calculating the quoted price on this bond that we just had, you would also have to know what is the default risk, so you can compute the expected cash flow in the numerator. Take off the blinders. The CAPM is a great theory. Everything makes sense. It pretends it's universal. But in real life, it doesn't work that well. So we want to use the CAPM, if at all, only in the places for which it has been designed. We don't want to use it for something like bonds. For something like bonds, we tend to believe we do better with other comparables that are also bonds and not rely on beta estimates that much, because betas for bonds are all very, very tiny anyway. Similarly, if we want to price real estate, a house, or other assets, go for other real estate or these other assets. These markets are also probably somewhat segmented. And sadly, the CAPM actually sucks empirically quite a bit. And I'm going to explain that to you in a moment. However, for the time being, we stick with it. So we know that the CAPM beta does not take care of the project's default risk in the present value expected return denominator. Does it take care of default risk in the present value expected cash flow numerator?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, in fact, the CAPM isn't even used in the numerator. There's no application for it. So for the numerator, you look at the expected cash flows of your project that you have projected, and you have to translate that into expected cash flows from cash flows in the best possible case. So, summary. Default risk. Credit non-payment risk is not priced by the CAPM. The CAPM has nothing to say about this. The CAPM gives you the expected rate of return, which is usually above and beyond the default premium. It's used in the denominator for the cost of capital, and its own input is already the expected, not the promised equity premium. Thus, it gives you the expected numbers too. It also uses the risk-free rate, but that is the expected number. For your own project, more default, lower price, yes, all true. But the way you take care of this is through the numerator, through the expected cash flows. So you've got to work with the expected cash flows in the numerator too. That has nothing to do with the CAPM. The CAPM also has different expected rates of returns across different projects in the context of a perfect capital market. So projects with higher market betas must offer higher expected rates of returns. The promised rate of return, however, also has to have the default premium in it. And the actual rate of return doesn't only have the default premium, which is the expected default number, which is 0, but also the realization. So it's going to be whether the project turned out better than expected or worse than expected. Do you know the CAPM inputs? Can you estimate them?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we already discussed the risk-free rate and the equity premium estimation in the previous chapter on benchmarking. You also learned that it's very hard to guesstimate the equity premium. You would want to use the project term equivalent risk-free rate. So if you have a cash flow that comes due in 30 years, don't use the 1-year treasury as the risk-free rate. We've done the risk-free rate. We've done the equity premium. What we haven't done yet is the market beta estimation. How do I estimate the market beta? We want a forward-looking market beta because we really care about how we hedge the future, not how it would have hedged in the past. But all we have is the historical data. So how do I find the correct forward-looking market beta for a project of a publicly traded firm? Well, the way I would do this is I would run a time series regression. Here's an example of the kind of data that I would want. I would have the expected rate of return on my project, which in the table I call RI, which I've given you about 500 days worth of returns. I would have to take the rate of return on the market, which is the row below it, and the risk-free rate. So what I would want to do under those circumstances is run a regression on Y, on X, where Y is defined as the rate of return on my project minus the risk-free rate, and X is defined as RM minus RF. And I stick this into my regression package. I say, please conduct an ordinary least square regression, and then take the second coefficient from that, which is the beta. I'm interested in the beta, not in the alpha. The OLS procedure is going to give me both alpha and beta. And if I want to do a little bit better forward-looking, there's an interesting procedure that you can do. What you should do is you should actually shrink your beta down a little bit towards 1. So you use this particular formula here, and you should do different on a 1-year or a 5-year project. And if you do that, you will have a better estimate of beta forward-looking than from the past. For example, if your OLS beta is 2, using the formulas I've just given you, for a 1-year project, you would instead assume that the forward-looking beta is about 1.7. Or if your beta is 0, you would assume that your forward-looking beta is about 0.3. They're just better predictors of market betas than just the historical market betas by themselves. If you only have monthly data, you're going to get lousy estimates of market beta. If you absolutely have to do it and you cannot get around it, use 0.5 as the shrinking factor instead of 0.3 or 0.4. Another mistake that people sometimes make is they think that maybe I shouldn't use my own beta but an industry portfolio or a peer beta. Well, that turns out to be really, really lousy. You would never do this if you don't have to. It's always better for your own firm to use your own historical data to calculate a beta from historical numbers. Never ever use accounting returns in lieu of economic returns. These are completely different numbers. It turns out that book equity from which these accounting returns are calculated are near meaningless. We're going to go over this later on in this course, but for the time being, don't ever use this. Accounting focuses on firm-specific cash flows. A lot of what happens in the economy is economy-wide, and the accounting numbers really don't take that into account. Stock returns take that into account, not accounting returns. Now, for your amusement, take a look at this. This is actually a video that I've done with some comedians about the CAPM. You may or may not enjoy this. That's it for this video and for the theory of the capital asset pricing model. In the next video, we'll put the model to work. See you soon. Bis bald. Why did the CAPM model get kicked out of school?
Why?
Because it kept saying, I'm better than everyone else.